All right. Sorry about that. I'm going to go back to where we were. I hope. There we go. All right, everybody back. Anybody? Did I lose anybody? We're good? All right. So let's see. Got moving from the asset on the balance sheet to expense on the income statement as it is sold. So we have two kind of things that we use to check ourselves, if you will. And that is cost of goods. Everything that we bought, all the inventory, basically has to end up in one of two places. Either it gets sold and it goes to the income statement, or we didn't, and it's still on our balance sheet. All right, that's how we account for inventory. And so on the income statement, we're going to always be able to figure out the number of units sold times a cost per unit. If we want to know what our cost of goods sold is, we need to know those two things: how many units were sold and what our cost per unit was. And on the balance sheet, if we want to know what our ending balance, or we want to check our ending balance, okay, then we need to see what the number of units we have on hand. What we mean by on hand is stuff that's still with us on the shelves, in the warehouse, wherever, times the cost per unit. All right, now we have to track both of those. Cost per unit, we're going to find out a little later, is probably the one that's going to give us the most headaches, but it is the important piece of it. So this is more like what you would actually see on financial statements. Inventories, $917 million, $17.5 million. You think about all of the Under Armour at all of their different stores, in their factories, in their warehouses, all that stuff quickly adds up to millions and millions of dollars of clothing and other items. When it is sold, okay, and during the course of the year, they sell $2.5 billion. So you can see that that inventory is circulating, if you will. And we'll talk about how we measure how quickly that is happening a little later. It's coming into the warehouse. We account for it. We put it on as an asset. Then it gets shipped to the stores, gets sold, and moves to the income statement in huge quantities. And of course, that's why we use all those lovely computers to keep track all that, because nobody would want to sit there and do that with paper and pencil, right? A couple of little items here to think about. Consigned goods, not, I like to say sometimes that this doesn't get used as much as it used to, but there's still a lot, decent number of people. The idea of a consignment is, let's say that you make a brand new product, and you're out in your garage, and man, you came up with the best little thing, and you decide that you want to sell it to the public, but you can't get people to come to your garage, okay? And so let's say that it's the kind of thing that it's kind of hard to sell online. And so what you want to do is you want to put it in a store where people are going to walk past it and pick it up, and they're going to go, oh, wow. So you find a place that will put it on the shelf, but they're nervous about selling it too. So they're not going to actually buy it for you. They're basically going to let you put it on their shelves. Okay. So And if it sells, they're going to take a commission. If it doesn't sell, they're not out anything. All right. So that's what's on consignment. That inventory, even though it's somewhere else, not in your garage, is still yours. It does not belong to the store who's providing you a shelf. Okay. So a lot of like craft places and stuff will put things out like that for people. I'm not sure how Etsy works for sure, but I get the feeling that at least some of that is like on consignment, meaning it doesn't really belong to the people that are there, that they kind of use that as a conduit. But it's just a minor thing. It's not going to drive us too much crazy, but it is something that you should be aware of. Stuff that's on its way to you or from you to your customer. The question is, do you own it? If it's in inventory, remember our definition of an asset is we have to either own or control it. And so the question is, when things are on their way to us or they're going to our customer, do they belong to us? Should they be in inventory, or should they belong to somebody else, the person who is receiving it or the person who's shipping it to us? And basically the answer is, well, it depends on the terms. All right. So who owns stuff while it's moving across the country? So I like to use the example, if it blows up, well, all right, in Nebraska, okay, on its way to Pennsylvania, is it yours? Who's got to go clean it up? Who's out the money because it, went kapooey, okay, and the semi jackknifed on I-80 and spilled it all over the side of the road. And you've all seen something like that happen, right? So you know that this is not just a theoretical thing. Who owns it? Okay. If it's FOB shipping point, then it changes ownership when it leaves the factory or the producer. Okay. So if you are the seller and you put it on the truck, you are done with it. It is no longer yours. So if you're the seller in California, you put it on a truck and it has a problem in Nebraska, okay, you did your part. Okay, it's no longer yours. You should still get paid for it. All right. FOB destination means it doesn't change ownership until it reaches the customer, whoever bought it. Now you're most familiar with FOB destination. Okay, that's what you expect on your doorstep with Amazon, all right? If it doesn't show up on your doorstep, you call the thing, you say, I didn't get it, and you don't have to pay for it. Now, you probably have already been charged on your credit card, but you can have that removed fairly easily, okay? So it is not yours until it gets onto your step. However, it's a little more complicated when you're talking about traveling across the world, shipping in large containers of stuff, and it's got to go through multiple ports and across the country on rail and then trucks. Who owns it during all that time? And so that becomes an important negotiating point between the buyer and seller. And basically, there's not a law. There's just an idea of what is the best for everybody, what is the cheapest way to get it, and that's what we will probably do, is FOB, shipping point or destination. From our standpoint, we need to know when it changes hands, because that's when we're going to change our accounting. If we're selling it, when it changes to the buyer, to our customer's ownership, we're going to record the sale. If we're buying stuff, we're going to put it in our inventory when it changes to our ownership. So it's going to determine not the journal entry, but it's going to determine the timing of the journal entry. All right, so here's the challenge that we mentioned earlier, the cost per unit of inventory. Which unit costs go into ending inventory? What unit costs go into cost of goods sold? This is not an issue if your costs are consistently the same. If you are always buying the stuff on your shelves for $5 a unit, then it really doesn't matter which units you sold or how to calculate cost of goods sold. Is really easy. You know that's $5. It's been $5 for all year long, and it stays consistent. And in an awful lot of situations, there are not that bigger differences in price, okay, or in cost for businesses. However, if you notice something recently, the price, one of the only good things of coming out of this little virus thing is the price of gas has done what? Gone down considerably. The cost of oil went down 30% in 3 days. When you have those kind of changes in cost, it makes a big difference whether you use the higher cost or the lower cost when determining your cost of goods sold or your ending inventory. But that is unusual. That is kind of not the norm. Most of the time, prices and costs change fairly, I don't know, are pretty steady. But we have to deal with the possibility that it could change more dramatically, like the price of oil has, or the cost of oil recently. So we are going to learn a perpetual system. And what that means is that we are going to keep track perpetually, meaning every day, of how much inventory we have. We're going to now track how many units we have and what their costs are, so that at any given time, our inventory will reflect on our balance sheet or in our computer system will reflect what's on our shelves. You can see why that would be important. You'd want to know how much inventory you have on your shelf. So you're keeping a running record of all those. You still got to check your things once a year or maybe more, but at least once a year. Periodic inventory is really not used for inventory anymore. Okay, it's really for supplies that really aren't for sale to customers. So we're not going to spend time on that, right? So you can kind of say chalk periodic up. You'll need to, you just kind of know it exists, but we don't really care how we're going to account for it, at least in the inventory setting. All right, we're going to focus on perpetual, because that's what everybody, if you noticed these days when you go and check out a place, how much everything is barcoded. I mean, there's literally, it used to be that small things were still stuff they had to kind of look up and things like that. But now it's like everything, even very small items. Even your produce has been stickered with every banana bunch and such has got a barcode on it these days. A lot of that's because of your self-checkout system. So we can track inventory by item all the time, perpetually, with just even small, inexpensive items too. And the computer allows us to do it quite easily. So this is, put this little star by your notes or whatever you need to do, but you need to remember that under a perpetual method, you make 2 entries every time you make a sale. 2 entries. You're going to make 1 entry for the sales price of whatever items you sold. That's going to be either a debit to cash or accounts receivable. So if you get you sell on credit, it's going to be accounts receivable. If you sell for cash or a credit card, you're going to debit cash, and you're going to credit sales or sales revenue. That's one entry. And that's just half of the story. The other half is a debit to cost of goods sold and a credit to the inventory. So make yourself a note that you need to have both, and you're not done until you do. So this is an illustration of the journal entries, okay? But what I would like to show you instead of that, not that instead of, maybe in addition to, this is the journal entry look at, but I like to see it this way. Let me show you a little different way to look at it. All right, and I have to stop at share, and then I'm going to share different screen. Can't just toggle. All right, so this is an Excel spreadsheet, and I don't know if you any of you have done this before, but these are what we refer to as T accounts, right? And I just like to draw them in Excel. I just use the border function if you like to set up anything like this. You put the account name up top. Notice our asset, liability, equity, accounting equation. And when you buy inventory, okay, you're going to put the amount in inventory, debit inventory, and credit accounts payable, because you're usually going to buy on credit. That's the sort of journal entry you've done lots of times before. Now, when you sell inventory, you're going to credit inventory and debit cost of goods sold. You also, right, we said we have to have two. Okay. We're going to say we sold those for $600, credit sales, and we're going to make it a cash sale so we don't have to use accounts receivable, because that's not our focus here. Okay. So that's how the T accounts work. So what's happening with your inventory, that's what I want to illustrate. And there's an example of this as well on your slides, PowerPoint slides as well. But this is just kind of a working model. Notice that our inventory balance is changing. Every time we make a purchase or a sale, our inventory, at least in a dollar amount, is being updated. Okay. Now, the T account can't keep track of the units. We don't know how many of it. We just know that whatever inventory we have has a cost of $200. That could be 20 items. It could be 10 items. We don't know that. We just know that it costs $200 at this point. Somewhere else, and accounting systems do this wonderfully, we would be tracking the units. Okay. But this is the kind of model that I like to use when I'm tracking the changes in inventory. And with a perpetual system, if you have a question about what should be affected, the answer is almost always it has to end up in inventory. For instance, remember this accounts, let's say we get a discount on this inventory we bought. Say we get a 2% discount if we pay early. So instead of paying $500 on this bill, we pay $490. That's 2% less. Okay. Now we got a problem, because here our credit is $490. Our debit was $500. That doesn't equal, right? We know debits have to equal credits. So we need a credit of 10 to go along with the $490. That gives us credits of $500. and a debit for 500. That reduction in the cost goes into inventory. So the point is, basically, when you're dealing with inventory, you've got two places for things to happen, okay, in terms of the cost, and that is inventory or cost of goods sold. And I just want you to be able to picture how that works with the accounting equation. All right, I gotta stop sharing, go back and share. All right. Yeah, I wish you could toggle that a little better, but it requires you to get out and do that again. So here's the T accounts, the demonstration in your in the slides. So basically the same idea. Purchases on the debit side of inventory, cost of goods sold, or how much you sold. The amount of what you sold goes on the credit side, and debit to cost of goods sold. Ending balance being the cost of the inventory that's still in, still on hand at the end of the year. And that's what it would look like on our financial statements. So a little bit about the idea of net purchases. Anything, the idea of inventory, whatever you're going to put in inventory should be the total cost to get ready to sell. So we need to adjust for anything we send back to the to our vendor. If we have to pay any extra shipping costs, if we have to do any of that kind of thing, we get any discounts, all those get adjusted to inventory and would be part of this idea or concept of net purchases. So these are examples of journal entries that we could also, and this last one was exactly the same as what I illustrated on the T accounts in Excel. Same type of thing, where we pay the bill and notice that the change, the difference is in inventory. Notice this purchase discount, inventory, okay? Inventory. Guess what, folks? If you're gonna guess an account, inventory is your best bet, right? Okay, if you're not sure where something should go. All right, these are the other costs that you might need to include in inventory besides the normal, what you see as the unit costs, any insurance while in transit, that sort of thing, things to consider. All right, now we're going to look at the various inventory cost methods. Now, what I would like for us to do is use a little different terminology. And I want you to think these are not necessarily cost methods. I want you to think of them as cost assumptions. We're going to make assumptions about the costs, all right? At least if it is not such that we can do specific identification. So that'll make a little more sense here in a minute, okay? But I think the term cost method actually sounds like we've created multiple ways to actually do the accounting. And the point is, the T accounts, the journal entries look exactly the same. These assumptions only affect the amount of the cost per unit. That's it. All right. If you sold 20 items, you still have to account for 20 items, whatever cost assumption you make. It has no impact on that part of it. Okay, but it does affect how much profit, again, income tax paid, and some of our ratios. But again, only when prices or costs of our inventory are changing. So here's the 4 that we expect you to be able to think through. And actually, we will focus our attention most on the average cost as far as the examples and your homework and so forth. So, not that you shouldn't understand the concept behind the others, but and basically the concept isn't difficult, but sometimes in practice it can get a little confusing. The actual application is sometimes where we have some trouble. So we're going to go through a couple of examples here. Okay. Now, specific identification requires the most computing power, but is actually the easiest. Okay. So it is used more and more today because of the cheap availability of computing power and the ability to identify things so much more easily than we had in the past. All right. So it was, most of you know that automobiles have a VIN number, right? It's a unique number. It is no other automobile in the United States has that number. So if I know that number, I can tell you the history of that car, right? Okay, that's what it's for. So if I have that number, I know exactly. If I bought that car, say I'm a dealer I'm a used car dealer. Let's make me a used car dealer, and I picked that up at auction for $5,000. Because I have to actually legally, I have to track that VIN. I know that that particular car costs $5,000. So when I sell that car, that very specific car, no matter what I did to it, I could paint it, I could, change the look of it, I could do whatever, it's still that same car. Then my cost of goods sold when I sell it is $5,000 plus whatever I cost of painting it. All right, so it's easy as long as you make sure that you've got a way to track it very specifically. Okay, so that is the idea. So this idea that it's too expensive for inventory with common characteristics is becoming less so in today's computer world. Literally, we can put little tags on almost anything today. But we still have some things that we choose not to track every single item separately. So this is the example, okay, that we're going to use to illustrate the various ways that we do this. So we bought 10 units, we had 10 units to start. We made 2 purchases, and notice we have different costs for each purchase. So the ones we bought first, and I would have preferred them put by date rather than number 1 and 2, but that's okay. We know that this one was purchased before this one. Okay, so this one was at $14, this was $18. So this is one of those examples of the cost changing dramatically. Pretty unusual, but of course they want to illustrate the point. So we know that there are 60 units. So you started with 10, you bought 50, 25 and 25. You had 60 units you could sell. You sold 40 and you end up with 20. So the number of units and the accounting for the units is the same no matter what assumption you use. If there was a way to know exactly which units you were sold, you would use specific identification. If you cannot tell, there is no way, and this is the point, no way that you can easily tell purchases not these 25 units from these 25 units. They're the same color, they're the same item, they're the same whatever, okay? Then you have to make what we call an assumption, a cost assumption. So first cost assumption is the average cost, or weighted average is really the more accurate term. What we're going to do is we're going to average them together and use that as our cost. So what we would expect is some number in between 10 and 18, right? Because if we're going to average these together, we're not going to end up with any one number. We're not going to end up with 10. We're not going to end up with 14. We're not going to end up with 18, right? We're going to end up with some weighted average. Now, that term weighted average is a little bit key in our calculation, okay? So here's what you do to get the weighted average cost of this. You take all the inventory costs available, $100, $350, $450. You add them up and you get $900. So you would do this when you make a sale. You would divide that by the number of units. So notice we're not taking 10 plus 14 plus 18 and divide by 3. That's how we're used to doing averages, right? This is a weighted average. We take the cost, the 100, 350, 450, get 900, divide by 60, and lucky for us, it ends up being a nice round 15 bucks. So our number of units sold are 40. We multiply by that, our result, and we get 600. And guess what? We use the same average cost, okay, for the 20 in the ending inventory to get 300. I like to say that with the weighted average, what happens is all of them become one. There's no such thing as $14 ones, $18 ones, $10 ones. They're all in one big pile and they all cost $15. All right. Now, what this doesn't illustrate as well as it could be is what happens if we sold it, okay, after we had only bought the beginning and the number one purchase, and this hadn't happened yet by date. Let's say we made a sale right there. Now we couldn't have sold 40 because there are only 35 units at that point. We always calculate the average cost per unit at the date that we make the sale. All right. Now, when you do your homework, all right, there's one of the problems that doesn't specify the date that we make the sale. So like this one, you're going to assume that the sale was made after the purchases. But using the perpetual method, at the point that we make this sale, if it was earlier than our purchase number 2, we would not include purchase number 2 in our calculation. We would only include purchase number 1. Now, why is that difficult? Because in real life, that's easier actually, because in real life, you're making this calculation on the fly, meaning at the time. You wouldn't even know you were going to make a purchase number 2. But when we write problems in back of textbooks, we give you all this material at once rather than giving it to you one day at a time like you would face in the real world, okay? So don't worry too much about that, but that is the issue, is calculating the weighted average happens on the date that we make the sale. Okay, so that's what the journal entry would look like. This is what your ending balance. Notice you can always check your calculations by taking the debits, subtract the credits, okay, getting your ending balance, and then and then comparing it to what you should have, the 20 units times $15. There's always a check figure with accounting, and with not everything in accounting, but if inventory, there usually is. First in, first out, the next assumption, okay? We cannot tell which of the items are actually sold, so we're going to assume we're selling the first ones in, the oldest ones. We're going to refer to this as FIFO, don't say FIFO, okay? All right, we don't want to be thought to be ignorant. FIFO, okay? All right, so when you sell at FIFO, make that assumption, you sell the old ones. And this is the most logical. This is the way you probably think, okay, for most of us. We sell the ones in the beginning inventory, 10 of them. Okay, we run out of those. We start selling the $14 ones, the next oldest ones, 25 of those. We sell 35 of those. We still had to sell 40, right? So we need 5 more of the $18 ones. So you're going to have some place off to the side to make this calculation. 10 units times $10, 25 units times $14, 5 units times 18. Add those up and that your sale of 40. Notice it's still 40 units. It's still 20 left, just like the other way, but you get a different cost of goods sold. So when we did weighted average, it was 600. For FIFO, it's 540. And that means our ending balance is 360. You will notice that 360 plus 540 equals 900. We're weighted average, it was 300 and 600 adds up to 900.
Okay, bye.
All right, the last one, the least logical of the bunch. One that makes us think that, who thought of this one? Okay. Last in, first out, LIFO. So now we're selling the most recent, the newest items. Or at least we're making the assumption that this is what happened. We don't know. So how would that work? Remember, the purchases are the same, beginning balance is the same, okay? We're going to sell which ones? The most recent ones, and then when we run out of those, we've sold all 25 of those, we'll go back to the ones right before that, 15 of those at 14.
Just like that.
So 25 units at 18, 15
no, I can see
14.
it.
All right. Notice that we get a different number for cost of goods sold and a different number for ending inventory. Our ending inventory is not just one cost. It's these original. Notice we still have these, or we're still making the assumption we have these units, and we have 10 more at 14. Okay. That's our 3 assumptions. And then we get a little, here's the example that anytime we make these calculations, it's a good idea to look at the cost of goods sold and the gross profit, which is sales minus cost of goods sold for each one. Because there was a big change in the costs, I mean, we started at $10, ended up at 18. There is a pretty big difference between average, LIFO, and FIFO. FIFO gives the lowest cost of goods sold, LIFO the highest, because prices are rising in our example. It went from $10 to $18. So when you do your homework, they're going to ask you to make the journal entries and then do this partial income statement, if you will, to demonstrate the difference between the different assumptions. Okay. So when inventory costs are going up, we're going to sell the low cost old items and keep or have on hand still the newest and most expensive items. Under LIFO, when the prices are going up, you're going to sell the newest, most highest cost items, and your ending inventory is going to be the old stuff, which is going to be the lower cost. That's the biggest complaint. Just so you know, the rest of the world has, other than the United States, has banned LIFO. So under international financial reporting standards, LIFO is not allowed and the biggest reason is they would claim that the inventory on the balance sheet is way old and therefore distorted. But companies who choose one or the other technically do not know whether prices are going to go up or down. If inventory costs go down, and in some industries that's the norm, then just the opposite is happening. So when you make a choice as to which assumption you're going to use and stick with it, you can't change based on whether costs are increasing or decreasing. That violates the consistency idea in accounting. So people say, why would anybody choose LIFO? It actually makes you, when prices are going up, makes you look worse. All right, makes you look like you have lower profits. And if you ever want to know when during the year do you want to look like you're the poorest, and that is when you report to the IRS, right? So there's always, anytime that you see a company that wants to look bad, you know it has something to do with taxes. All right, so if you want to reduce your current tax expense, then you might have chosen LIFO with that in mind. But again, that only works if prices are going up. So there's a risk that they could go down. For instance, like oil companies are experiencing right now. And most oil companies do use LIFO. So they're not going to pay less taxes. They're going to pay more taxes as this current year, if the current trend keeps up. All right. So these are the back and forth arguments between the two. All right. LIFO is a little more realistic net income figure. FIFO a little more up-to-date inventory costs. I'm not sure that I actually buy into your author's contention that LIFO allows for greater manipulation of net income. It is a popular thing if you go on Investopedia and you say, why is LIFO bad? It will say exactly that. It allows manipulation of net income. I think if a company is so bad and so bad off that they're buying large quantities of when inventory prices are rising just to manipulate net income, they are probably doing lots of other very bad things as well, because that seems like a very desperate and expensive way to manipulate income. The LIFO liquidation is a little more common and more of a concern, but there actually is rules under GAAP that make that not able to be done. I mean, if there's a rule against using that to manipulate your income and the description out, and I won't go into that, but so I just put this a little bit on the idea of, well, I'm not sure I buy that explanation. All right, so a little bit about the GAAP rules. Since we've got the mechanics, you might say, of those assumptions. What do we need to do to keep according to the general principles of accounting? We need to be able to disclose everything that's necessary, show what actually happened, and be consistent. No flip-flopping back and forth between assumptions. All right. Lower of cost or market. This concept tends to give accounting students a little bit of a headache. And the reason why is we're dealing with inventory that we still own. Okay, so I want you to imagine that you have inventory that is being difficult to sell. It's obsolete, it was unsafe, it was not what everybody wanted, it was dolls for a movie that flopped and nobody went to, and so no one's buying the dolls, whatever. Any of those kinds of things could happen, okay? So our issue with that is when we bought that inventory, we thought, yes, we'll be able to buy it for $20 and sell it for $40, all right? But now it has become apparent that no one wants it for $40. No one maybe wants it for $30. And what do we do with material like that? We just keep marking it down. It goes on clearance sale, then it goes on super clearance sale, then it goes on extra super duper clearance sale. You know the idea, okay? Which is when, I buy stuff, right? When it's, when they're trying to give it away. That's what we're trying to account for here. All right, so what GAAP says is that inventory on the balance sheet has to be the lower of its cost, what we paid for it, or what we could sell it for. Now, remember, let that sink into your head a little bit. Remember, the idea is we always want to sell our inventory for more than we paid for it. So if we think that to sell it, we're going to have to sell it for less than we paid for it. That's a big change, you might say, in our plan. It is not what we would expect. All right, but if it happens, if there's piles of inventory that we know we can't sell at the regular price, and we've tried to sell it at a reduced price, and we're still having a hard time selling it, then we may have to say to ourselves, we know that this isn't worth what we originally paid for it. And as such, we have to reduce the amount we put on our balance sheet down to what it's really worth, because that's lower than what we actually paid for it. Okay? And that market value, what's worth, is referred to as net realizable value. And net realizable value is what we think we could sell it for minus any costs to sell it. So most of us in the central part of Pennsylvania have heard of Ollie's bargain outlets. Well, where does Ollie's get its stuff? Okay, it sells things cheap. That's its advertisement. Okay, because it buys stuff that is obsolete from other places, people that, other stores couldn't sell. So they need to get it off their shelves. Okay, so they call up Ollie's and they say, we need to sell this to you. All right, that is an indication that you have a lower of cost or market. You are probably selling it to Ollie's for less, okay, than what you paid for it. And therefore, what you can sell for Ollie's minus the cost to get it to Ollie's is going to be your net realizable value. So example, this is a very broad example. Underpaid $3 million for inventory. That's its original cost. But at the end of the year, inventory can be replaced. Now, this is not, it should say that inventory could be sold for $2 million, okay? The year-end balance sheet must report this inventory at the $2 million, the lower of those two. So what is your journal entry? And here's where the mistake sometimes gets made. We know that we got to make our balance sheet $2 million. So our first thought is to make a journal entry for $2 million. No, 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 no. We already have $3 million in inventory. To make it 2, we need to make it go down by $1 million, right? The difference, the loss. And then we credit inventory and debit cost of goods sold. So that looks, folks, like a sale, doesn't it? That's what we learned way back in slide 5 or whatever, that we do when we make a sale. But no sale was made. This inventory we still have it. It's still stacked in the back. It's still, you know, on shelves somewhere. That's where it's tricky. We are reporting a loss on inventory before we actually sell it. All right. That's the rule. So we're show our readers of the financial statements that we had a problem, because that's exactly what this is. It demonstrates that our purchases were not as smart as they should have been, which is why we have this inventory we can't sell. Okay. So here's how it would look on the balance sheet. Notice it was $3 million on the inventory. Now it's $2 million. And the cost of goods sold is going to go up, which is hurting our gross profit, right? It's going to make our gross profit, instead of 12, went down to 11. Okay. And that's really what happens with any loss of inventory. Now this, we talked about it, the hardest case is the inventory lost its value because it was not wanted by customers. But we could also have it walk out the door because of theft. We could have it damaged because of flood. Any of those things would have the same impact, would have the same journal entry, if you will. How much we lost would be credited to inventory and debit the cost of goods sold. All right, some ratios, calculations. When we want to compare our inventory and compare how we're doing to past years or to other companies, we use these ratios, okay? The first one, gross profit percentage, or referred to often as gross margin or gross margin percentage. So we take revenue or sales minus cost of goods sold, that equals gross profit, right? And then we divide it by the sales again, or the net sales revenue. So the idea is, I bought clothing for $40 from my supplier, and we sold it for $100 to our customers. So 100 minus 40 is 60. That's our gross profit divided by 100. That's a 60% gross margin or gross profit percentage. And of course, you want that to be as high as possible. So you're always doing, you can do, you know, you're either increasing your price if you can, or you're reducing your cost of goods sold to be able to improve this percentage. So they did that for Under Armour, got about 46%. So that means that Under Armour is selling things such that they make roughly, if you buy something Under Armour for $100, you know that it costs them right about $50 or $54 to make or to buy it. Okay. And you compare that to other companies, you notice how close these two companies are, and that's very common. When companies are competing directly against each other, they almost always have very similar gross profit margins. All right, inventory turnover. How efficient are you at selling your inventory? Notice we're taking our cost of goods sold and we're dividing it for the year. So we would take the cost of goods sold off the income statement for the year. We would look at the balance sheet, and we need the beginning of the year and the ending of the year. So we need two balance sheet numbers. We're going to take that inventory, we're going to average it together. This is the normal average way. We take the beginning plus ending, divide by 2. And our inventory turnover is going to be the cost of goods sold divided by that average. It's going to be a ratio. It's going to be like a number. It's going to be like 4.5 or 6.4. Okay, it is not going to be a percentage. And you want that to be high, but you don't want it to be too high, because at the point that you have too little inventory, this number is too low, which makes our inventory turnover way high. That means that you don't have enough to satisfy customers. That means that they're coming in, they want to buy stuff, and they can't. You're out. And that just ticks people off. So we want to have inventory that's enough to make our customers happy, but not too much. Because the longer it sits around, the more likely it is to have something bad happen. So we want to have the right inventory that people want to buy so that it sits for just long enough that they can come in and buy it. That's the goal. Now, once you know what your inventory turnover is, it's not hard to calculate your days inventory outstanding. This is how many days, how much time it spends on the shelf. All right. You take the inventory turnover and divide by 365. Wait a minute. That's backwards. Okay. It's 365 divided by inventory turnover. Sorry about that. I didn't catch that as I went through these. Okay. So we'll tell you how many days they were on the shelf. So it really is going to be affected by the same as this, right? Because it's really just a different way of looking at the same thing. As your inventory turnover goes up, your days in inventory will go down. They move in the opposite direction. So if you were thinking about a typical retail clothing store, they like to have inventory turnover of around 4, meaning they're going to turn over their clothing and get it out and get some new clothes in every season, right? You're going to have your winter stuff, your spring stuff, your summer stuff, your fall stuff. Okay, so they like to turn over inventory 4 times. Okay, so if you take 365 divided by 4, you're expecting their inventory to sit on the shelf for about 90 days. So they're once a quarter, they're going to sell the inventory. This is kind of their goal. Okay, and you can see that Under Armour only gets 3 times per year, okay, which ends up being about 120 days that they sit. So they have the formula right over here. 365 divided by the turnover. Okay. And you see that Nike is closer to that 4 than Under Armour. All right. All right. Let's see. The cost of goods sold model. Oh, let me check the chat here. Question was, turnover goes up and days in inventory yes, goes down. They move the opposite direction. So if your turnover went down, okay, your days in inventory would go up. So they always move in the opposite of each other. Okay. All right. Make management decisions. So this is your, I like to say, your check figure. When you're using the perpetual inventory, you're calculating cost of goods sold every time you make a sale. But at the end of the year, or at any point during the process that you need to check how things are going, or whether your calculations are correct, this is the way you do this. Okay, so this is an important formula. If you're missing any information, this is a way to try to figure out what you may be missing. So this is one of those things in accounting that I like to say probably is worth memorizing. Okay, I don't like memorizing a lot of things in accounting, but this is probably worth it. So you start with beginning inventory, add purchases or net purchases, and that equals your cost of goods available. That's what you could sell. If you sold everything, that's what you have available. So you add those two together. You could sell what you had when you started. You could sell what you bought in the meantime. And then you subtract out what you didn't sell. That's your ending inventory, right? That's what stuff is still sitting around. So that's your backdoor way or your check figure for cost of goods sold. Okay. So you subtract your ending inventory and equals cost of goods sold. So companies use this to estimate what they need to buy by rearranging it. If we're going to sell 6,000, cost of stuff that's cost 6,000, and you want to have some ending inventory at the end, you don't want to run out, and you know how much you started with, you can project how much you need to purchase. You can see that that's just a rearrangement of that model from the previous slide. This is something that you'll do in accounting 200. You could also use it to apply the estimate of items that are lost or missing for some reason. For instance, if there was a flood or something. So if you knew your beginning inventory, you knew what your purchases were, all right, but you lost your data as to what your cost of goods sold is, or you lost your ending inventory records, or you have to show to the company, to the insurance company, how much inventory you would have had when the fire happened. So you may know this, you may know that, you may know this, but maybe you haven't counted your inventory for a while. So they're going, okay, well, how much inventory did you have when the fire broke out? Well, you could put this together, figure out what your cost available, and instead of subtracting any inventory, you'd subtract the cost of goods sold and get the ending inventory. So again, just not a something you use all the time, but certainly as a backup plan in the event of emergency. Okay, so here's an example of doing that under a fire. You have to make an assumption that your gross profit is 35% and that it stays consistent. And that is a reasonable assumption in most cases. Okay. All right. Inventory errors are last learning objective. Here's the problem with making a mistake in inventory. From our formula, let's remember our formula real quick. I'm just going to, inventory is at the beginning and inventory is at the end. We have an ending inventory and a beginning inventory in this calculation. So if I screw up either one of these numbers, I'm going to change this number. All right, so beginning inventory for 1 year is also the ending inventory for the previous year, right? So a mistake in this inventory number is going to affect this, and it also affected the year before. All right, because it was part of the ending inventory the year before. That's what it means by an error in ending inventory creates errors for 2 accounting periods, 2 years. Now, if you fix the inventory in the second year, at the end of the second year, then what will happen is those errors will, what we call, counterbalance. They'll offset each other. You'll be off one way on net income in 1 year and the other way the next year, and then it will be fixed. Okay. Beginning inventory and ending inventory have the opposite effects on cost of goods sold, because in the formula we showed you earlier, the one you're going to try to memorize, beginning inventory is added, ending inventory is subtracted. So an error, okay, affects cost of goods sold, and then therefore your income statement the opposite direction. So here's an example. Okay, we got period 1, ending inventory is overstated by 10,000. So your inventory was 20,000 when it should have been 10. Okay, but we didn't know that at the time, so we go on our merry way. We subtract the 20, and our cost of goods sold is wrong. Our gross profit is wrong. Whoops, sorry about that. And our net income, of course, that year is wrong by the 10,000 that were wrong on inventory. Not only is that year incorrect, but that 20,000 comes over here, and this is wrong. Okay. However, in year 2, we get the ending inventory correct. That means that while the inventory is correct, cost of goods sold is wrong for this year as well by $10,000. At least we didn't make it worse by screwing up the ending inventory as well. The point is that gross profit was off period 1 one way and off the other way in period 2. So what should have been the case is that each year should have been 50. It should have been 50 and 50 if we'd have done it right. But because we made a mistake, it's 60 and 40. The total is still 100. So together, period 1 and 2 are offset each other. But if you were comparing year to year as a reader of these financial statements, you would be very concerned about why gross profit went from 60 one year to 40 the next year. And it really didn't. It was because of an accounting error, which is why GAAP says we have to go back and change those financial statements for our readers. Okay. And because we got beginning inventory and ending inventory correct for period 3, it is fine. We don't have to make any fixes. So if we had to go back and fix this, okay, we would have to change our gross profit down by 10 here and up by 10 here. That's the point. That's the way inventory errors work. It's always 2 years affected. So here's a little summary of that you could refer back to if you need to in terms of how to think through an inventory error. If any inventory is overstated, your cost of goods sold moves in the opposite direction. Remember, because everything has to still balance. Because even though you make an error, balance sheet still balances, debit still equal debits equal to credits. And so there has to be a way that happens. If any inventory, because on the asset side is too high, then something else on the liability or equity side has to be too high as well. So our wrap up, okay, you got to make a decision. Which inventory system, remember our term was assumption, okay? Assumption we're going to use. We're going to basically only talk about perpetual. That really is the only choice today for anything that is truly inventory. Even fast food restaurants are using perpetual inventory these days, okay? Of course, if it's unique and we can use specific identification, that is the best. All right. And which cost assumption, and this is a choice. I will tell you that, for instance, QuickBooks only allows you to choose average. So if you were actually utilizing that in a small business, then you don't get to choose, okay? But as far as the actual calculations are done, if you want the system to do it for you. And otherwise, companies can choose any of the 3, at least in the United States, cannot choose LIFO outside the United States. And this is copyrighted, so don't send it to all your friends. I'm sure that they are very disappointed that you don't. So, questions. Let me stop sharing for a minute. Go back to the regular. What do we have? Anything that wasn't clear? You can put it in the chat. You can put yourself off mute, ask a question. I'm not seeing any questions. So So what I think the best way to go forward is for you, now that we've gone over this, to try to do the homework that is listed in your syllabus. Problem 623A, 24A. That's basically a calculation of your inventory equation and gross profit. So that last inventory equation that we talked about memorizing, or the calculating gross profit. Problem 660A is doing the journal entries or T accounts for average cost assumption with purchases and sales. That's the one that you're going to need to assume that you made your sale at after you made your purchases. Problem 663A is going to apply all three methods or all three cost assumptions in a problem. 664A is lower of cost or market. So you're going to have to look at the possibility of a loss on inventory that has not been sold yet. And 671B is another one that you're going to get a chance to do all three cost assumptions and then compare what they look like from a gross profit, gross margin standpoint. Oh, good. Anybody else? Let's see, could you post the homework questions either in the chat or on D2L? I can do that.
Thank you.
Oh, I didn't copy down the page numbers, but the problems are 623A. Well, I'll put them on. I'll put them in Brightspace. Let's see. I guess I can put it in chat right now. Oops. Now, as I understand it is that Dennis will be back with you on Wednesday to look over these homework problems with you and also review anything else that's necessary for your second test, which we will have to be creative. I will create a Dropbox in Desire to Learn for the homework, and it will also have in the Dropbox a list of the problems as well.
Are we doing 671B or 691B?
Ooh. I wrote down, I think it's 671. Does
Okay.
it go up to 91? I don't think it goes that high, but
I found on the back of the syllabus where like right here is the homework.
yeah, that's what I thought I copied from. I
You
think
did.
I think I got the right ones. I think it actually says on that, it might say 71A, but
It does.
it changes to B. There is no 71A, I don't think. Okay.
On the back, it says 71A.
Yeah, I think it's supposed to be 71B.
When is the homework due?
Okay. Thanks, Robert, for coming in. Was there another question?
Yeah, when is the homework due?
Let's shoot for getting as much as we can done by Wednesday, but I'll defer to Dennis making that determination as to. I will put it open-ended due date on the Dropbox, okay? Rather than try to guess how we're going to make up for lost time, all that kind of stuff. So. Just say your experience on Wednesday will be more productive if you have already done the work, right? Rather than trying to copy down stuff as it explains it. But to facilitate turning it in, I will create a Dropbox, but I will not assign any grade or anything like that to it at this point. That'll be up to
The Dropbox.
your
will be on Brightspace.
your real instructor.
The Dropbox will be on Brightspace.
Yep. I'll put it, I created a content module called Chapter 6. I'll put it in there. Okay. Anything else? Any other concerns, questions in general on other things other than inventory? Life in general. Everybody good? I hope you're all well and are staying appropriate distance from all of those sick people that are wandering around out there. So, but getting some sunshine too. Get outside a little bit at least too. Good for the soul. Otherwise we'll all be insane and then it won't really matter whether we get the virus or not. We'll have the same symptoms.
Thank you for teaching our class today.
Yeah,
Absolutely. It's been a little while since I've done that material. I forgot how much fun it is. So thanks for letting me come and practicing again. So I will do the things that I've told you I will do, and seeing no other questions, I will stop recording this, and then it will also get posted into what I usually do with my recordings is I upload them to YouTube, and then I put the link in Brightspace, okay? So that you can access that and watch it again and again if you really are that bored, okay? And whatever, but that will take a little bit. It takes a little while for it to convert, and so please don't expect it to be within 15 minutes or so. It may take a little bit this is a pretty long video. So both YouTube and Zoom is going to take a little while to get this ready to go. But if you're patient, by the end of the day, it should be up and ready to rock and roll more times if you need it. Okay. All right. You guys have a great day and be good to yourselves and everybody else. And maybe I'll see you again, maybe not. But anyway, it was a pleasure. Thanks so much.
Thank you.